Hey everyone, welcome to this explainer. Think of me as your peer analyst today. We're taking a really dense institutional market report and translating it into a high-energy, actionable playbook so you can actually outsmart the current market. Look, if you're trying to build your portfolio right now, navigating these economic headwinds can feel pretty daunting. But the truth is, volatility creates opportunity. Today we're analyzing the Philippine Stock Exchange for the week of June 8, 2026, and we're distilling all this institutional data into the exact strategic moves you need to be making. So, here's our game plan for today. First, we're surviving the stagflation era, then hitting the top blue-chip buy zones, checking out the watch list and dividend plays, flagging overpriced stocks to avoid, and finishing up with a quick portfolio reality check.
All right, part 1, surviving the stagflation era. We've really got to start by setting the stage with these macroeconomic headwinds, because understanding this pain is exactly how we uncovered the deep value opportunities. You simply can't make smart stock picks if you don't understand the environment those companies are operating in.
Just take a look at this massive 7.2% year-over-year inflation rate from April 2026. This was driven heavily by elevated oil prices. With all the geopolitical tensions, especially out in the Middle East, we've seen a real oil shock. And what that means for us is that the cost of doing business, and honestly just the cost of living, is running incredibly hot right now.
But here is where you get that macro whiplash. Right alongside that blazing hot inflation, Q1 GDP growth has slowed sharply, down to just 2.8%. It's a brutal combination, honestly. Prices are soaring, but the overall economic engine, it's sputtering and significantly slowing down.
So what this means is we're officially in a stagflationary environment. This mess forced the BSP to hike rates to 4.5%. Now, while that absolutely batters rate-sensitive sectors, it actually opens up some major opportunities in blue chips. The central bank literally had to reverse course from cutting rates earlier in the year to hiking them back up. It's a tough headwind if you rely on borrowing, like property and banks, but it creates exactly the kind of deep value entry points that smart, patient investors look for in top-tier conglomerates.
Which brings us to part 2, top blue chip buy zones. Let's switch to offense and see how this builds into our buy category for conglomerates that are currently trading at or near their 52-week lows. You might actually want to screenshot this target matrix. These are our S-tier picks: SM Investments, JJ Summit, and Ayala Land, complete with the precise price zones you should be scaling into. Notice we aren't just buying at whatever the market price is today. We have very specific entry zones. For instance, JJ Summit is currently at 2660 pesos, but with a trailing PE of 7.57x, it's one of the cheapest blue chip conglomerates out there, giving you exposure to everything from aviation to food. Our target entry there, right in that 24 to 27 peso range. Then there's SM. SM's diversified retail, property, and banking mix gives it some serious high inflation resilience. That makes our 580 to 620 peso entry zone historically cheap for a stock that actually has an average analyst target of over 900 pesos. When you consider its forward PE's just 9.07x, you realize the market is offering a massive discount on a company that literally just posted almost 160 billion pesos in Q1 revenue. Crazy, right? And then we have Ayala Land. This is the ultimate contrarian pick right now, sitting at multi-year lows. It's been heavily beaten down by those rising rates we talked about, which makes that 13 to 15 peso zone perfect for a really patient 12 to 18-month scale-in. Now, with softer residential pre-selling and compressed margins, the crowd is running away. But check this out. 11 different analysts give it a strong buy with a target price around 27 pesos. That is almost double its current 14 peso price. It's a phenomenal long-term value case, if you have the patience. All right, moving on to part 3, watch list and dividend plays. We are shifting to defense here with targets that provide a safe harbor during these high interest rate hikes. Because sometimes the best offense is a bulletproof defense. Check out how Meralco is acting as the ultimate defensive income play right now. It's offering a 4.53% dividend yield, which actually beats the central bank's hiked policy rate. Meralco recently pulled back from its April high of 655 pesos down to 545. And since it's a regulated monopoly that can just pass generation costs right through to the consumer, it functions as an incredibly good inflation hedge while literally paying you steady income. For the rest of the watch list, which includes BDO, Aboitiz, and Ayala Corp., the whole strategy is just patience. We want to wait for these specific price zones and macro catalysts, like the rate cycle peaking, before we even initiate a position. Take BDO, for example. It's a powerhouse, sure,
but higher rates create uncertainty around their net interest margins. So wait for that rate cycle to peak, probably in Q3, before jumping in at the 110 to 120 peso zone. Same deal with Ayala Corp. You really want to wait for a pullback to the 480 to 520 range, because right now it's just sitting way too close to its 52-week high.
Part 4. Overpriced stocks to avoid. Let's get into the warning section, because knowing what not to buy right now is just as crucial as knowing what to buy.
Just take a look at the massive premium on ICTSI this week. The stock literally just hit an all-time high of 892 pesos, and it's trading at almost double the valuation of its industry peers. The premium here is wildly apparent. While the industry average PE sits at a pretty reasonable 12.4x, ICTSI is commanding a staggering 23.8x multiple. No way.
Listen, ICTSI is absolutely a world-class company, but as young investors, we have to learn to separate a good company from a good price. Chasing a stock at these stretched premiums is just a bad move. Hold off until it corrects back down to the 700 to 750 peso range. Sure, they recently had a growth-positive acquisition in Portugal, but chasing an all-time high in a stagflationary environment, that is incredibly risky. Finally, Part 5. Your portfolio reality check. To wrap up this briefing, we're distilling all this institutional data into a quick, actionable checklist for your own portfolio. Because theory is great, but execution is what actually builds wealth. So pull up your current portfolio and let's run it through this reality check. Are you actually targeting 52-week lows? Are you scaling in gradually instead of just dumping all your cash in at once? Are you maintaining a 12 to 18-month horizon? And are you waiting for interest rates to actually peak? This checklist right here is your absolute best defense against emotional investing. When you see a stock like a yellow land heavily beaten down, it's so tempting to throw your whole account on it, right? But this high-rate environment dictates that we have to scale in piece by piece. As you adjust your strategy based on this explainer, I want you to ask yourself a serious question. Is your portfolio properly positioned to not just survive stagflation, but absolutely capitalize on it when the interest rate cycle finally peaks? If you actually implement the disciplined entry zones and defensive dividend plays we've covered today, you are going to be well ahead of the curve. Keep this playbook handy, stay patient, and let the market come to you. Catch you next time.